In the first 2000s decade, the S&P 500 had a negative annualized average return of almost 3% when we exclude dividends. This means on average for 10 years, stock investors had losses, and we just can't lose perspective. We can't lose sight of this. A bear market threat is even bigger now for most investors than it was back in 2000 because most investors have a very high percentage of their money in stocks and a small percentage in bonds, since bonds don't pay much interest and show little hope for providing meaningful gains. While bonds in a portfolio help mitigate the risk of stock bear markets, the protection is very limited because most portfolios hold a much smaller percent of stocks than bonds, especially now for the reason just given. And two, this is compounded by the fact that bonds usually rise much less than stocks fall. So losing money at any age can have irreparable damage to portfolios. Bear markets are particularly problematic for investors near retirement. There's something called sequence of return risk studies that confirm if there's a stock bear market in the years just before or after retirement, it significantly lowers the likelihood that your retirement funds will last for life. Now that I've completely bashed bear markets, I want to mention the flip side, and that's being positioned to capture the ride back up. That's where some serious money can be made. Yet many investors miss the fantastic bargains that follow bear markets because of the recent horrible experiences they've had with the stock market when the bear market happened.